Hey, welcome back to the channel. If you're new here, my name's Chris Hammond, and on this channel, we talk about a lot of topics related to retirement. People that are already retired, or maybe they're, say, 10 years before retirement, and we talk about all the things financial related to that. Now, one of the big things that we talk about a lot is taxes. And today we're actually going to talk about how to eliminate taxes on your gains. There's certain accounts that you can actually eliminate your taxes on your gains under certain scenarios. So this is called the step up secret. Now, it may not be a secret to you as we get into this, but not everybody is aware of this. So I always thought it was a good idea to go over this topic. So let's kind of get some foundational concepts laid out. Now, this is referring to non-IRA accounts. Like we're not talking about IRAs, Roth IRAs, 401ks. We're just talking about kind of like regular accounts. What we call those in the financial planning world is non-qualified accounts. That's what we're referring to here. And there's a couple of concepts that we have to understand in order to know how to eliminate your gains. And when we say gains, we're just talking about, you bought something for $1, now it's worth $10. That means you had a $9 gain. That's what we're referring to on this. And if it's possible to not pay tax on that gain, hey, that's really good, especially if you're following all the legal codes and laws and tax code and all that, which you need to do. So let's talk about some foundational concepts. There's this idea, this thing called basis. Now, there's a lot of jargon out there in the financial planning world that can be confusing. So let me break this down. I'm going to list these off one by one. If you're listening to it on the podcast, it's okay. I'm going to talk you through it. I'm going to talk you how to land the plane here. So basis is essentially what you have in the investment. All right. There's a lot of details of what can go into basis, but we're going to keep it real simple. So if you buy a stock for $100 and it's now worth $500, your basis in that stock is 100. That's what you got in at. Okay. That's what basis is, how much you've put into this. The next thing to understand, foundational concept, is what is the gain? Well, in that example, the gain is how much it's gone up above your basis. If it goes down, you actually have a loss in that. Maybe when you sell it and you realize that loss, you can potentially you can write it off on your taxes. But a gain is where you go up. So going back to that first example, you buy a stock for $100. It's now worth $500. You had it for 100. That gain is $400. That's what the gain is on that. These are really important concepts to keep in mind when we're going through this. Now, also keep in mind, this is for non-qualified assets. So this does not apply to IRAs, Roth IRAs, 401ks, TSPs, things like that. They are treated differently under the tax code than what your non-qualified accounts are. A non-qualified asset, like in the financial planning world, you just think of it as just like a regular brokerage account. You put money into it, you invest in some stocks and bonds, and they pay you some dividends, and every year you get a 1099 on that account for the dividends it paid you. Or if you sold some of those stocks during the year and you had a gain, you get a 1099 at the end of the year that you show to the IRS. You're paying taxes on either the gains or the earnings that happened or the income flows like dividends that happened during the year. That's what a non-qualified asset is. Something else is a non-qualified asset. It would be something like your house. You put after-tax money into it to buy the house, and hopefully, given enough time, maybe you're in a good market, it goes up, it appreciates, and that's a gain on that. So that would be examples of non-qualified assets. And now we need to talk about also gifting of appreciated assets. So it's kind of like these words that are used in the financial planning world. They're kind of like shorthand. So like when we say appreciated assets, we're not talking about like, I really appreciate what that asset did for me or anything like that. We're actually talking about something that has grown in value. So it's just easier to say appreciated asset instead of saying an asset that has grown in value over time. Right. So that's what it's saying. So try to walk you through some of these words that you may come across that can, if they're a little confusing, don't let them scare you. So gifting of appreciated assets. So if I have some stock that I bought for $100 and it's now selling worth $500, and if I sold it and get $500, I'd have that gain of $400. Or I could gift that stock to, you know, somebody I love, like a child, one of my kids, you know, something like that. If I gift them that, they're gonna receive it and they're gonna have that same basis starting point of 100, and they'll still have that gain in it of from 100 to 500. That's a $400 gain. They'll still have that. So if they eventually sell that stock, they're going to have to pay tax on it. And that kind of goes against the whole topic of today's video of eliminate taxes on your gains. Okay. So when you gift an appreciated asset, an asset that has gone up in value over time, that does not eliminate the gain that is in it that will one day have to be realized. And by realize, that's another one of those words. It's not saying, you know, I realize that I have, you know, a higher value. It's not that. It means that you have an asset, it's gone up in value, and as long as you haven't sold it yet, you haven't realized that gain. That's what that means. But if you gift that asset to somebody else, that gain is still in it. If they sell it for 500 and you had bought it for 100, it's as if they had bought it for 100 and they pay tax on that gain of 400. Okay, so gifting appreciated assets does not get rid of it. The way you eliminate taxes on the gains on these non-qualified assets is that there's a thing called step up in basis, and that happens when you pass away. So if you have that stock that you bought for $100 and it's now worth $500, when you pass away, whoever you have listed as your beneficiary on that account to receive that stock, they are going to get it as if they paid $500 for it. And if they turned around the day after you died, even before your funeral, and they sold it for $500, they wouldn't have to pay tax on it because it's as if they bought it for $500, they sold it for $500. There's no gain there for them. So step up happens at death. Okay, so that's how you eliminate taxes on your gains for these non-qualified accounts. It's the step up secret. Well, let's walk through an example of how this might look and how you might want to apply this, you know, or think about different ways you can apply it. Understanding that a video like what you're watching here on YouTube, or if you podcast listeners, understand this is obviously not financial advice for your individual situation. But let's use this example. If you're listening to the podcast, I'm going to talk you through it here as we go through this list. Let's say a person has an appreciated stock portfolio. Again, all that means appreciated, not that I just appreciate what that stock portfolio did for me, but that it has appreciated, gone up in value over time. So let's say you have an appreciated stock portfolio, and let's say this individual, they bought it for $100,000 is what they've got in this portfolio, and they bought it, and it was 20 years ago. And it's got a collection of different stocks and bonds, all that good stuff in it. It's not an IRA. It's a non-qualified account. That's what it is. And now that portfolio is now worth $500,000. That means it has a gain in it of $400,000 that we would say it's an unrealized gain, meaning they haven't sold it yet and actually realized this $400,000 of cash come into their bank account. That's what that means. So they have this gain of $400,000 in it. Now, here's the background. The owner in this case is, say, a 90-year-old woman. She's in a nursing home. She doesn't have that much longer to live. She doesn't need the money, and she wants it to go to her daughter. If she gifts that appreciated asset to her daughter, and then her daughter would have the $500,000 portfolio, and one day the daughter may decide to sell it for cash. Well, when she does sell it for cash, and let's say she sells it for $500,000 the day after her mother gifts it to her while her mother's still in the nursing home. And let's say she sells it for $500,000. She's going to have to report a $400,000 gain. Her basis will be what her mother bought that portfolio in at 20 years ago. All right. Now, if she wants that money to, and if she does that, she's going to pay tens of thousands of dollars in capital gains taxes to do this. And it may even push her up into different tax brackets that cause other income, you know, taxes and things like that to occur. Now, if the grandmother, or I'm sorry, if the mother that's in the nursing home does not need the money and she just wants to sit there, she wants it to go to the daughter, she'd be better off just letting it go to the daughter when she passes away. And then the daughter inherits the account, and her basis will be stepped up to that $500,000 amount, or whatever the value of that portfolio is on the day that her mother passed away. So if she turns around and sells it the next day, she's not going to have any capital gains taxes on that account if she sells it, right at what her new basis would be. That's the step up in basis is what that is. So really important thing to understand. This would kind of fall under not only just tax planning, but also under it's almost like an estate issue, because it's where your beneficiaries, where the money's going, and what's the best, most tax efficient way to get them to that. So understanding the step up secret is very important for your non-qualified accounts. If you need some additional help on retirement planning, be sure to head on over to my website, retirementplanningmadeeasy.com. I've got a free essential step-by-step retirement guide that you can check out. It's got even a little worksheet on it where you can line item and do some income budgeting and things like that. That's going to help you determine how much money you're going to need in retirement and how much it's going to cost you each month to live in retirement, so you can do better job, a more accurate job of planning for maybe even how much money you need to have saved before it's safe to finally pull the trigger and leave your employer for good and enjoy life. That's all we got for today. Thanks for watching. I will see you guys on the next video.